Think you're too busy to build wealth? In midlife, stability becomes key. But who has time to track stocks? This video is for you. You don't need to be a financial expert to invest successfully. We'll reveal 5 simple, low-stress strategies designed for busy people who want to grow their assets safely and steadily. Learn how to build lasting wealth with peace of mind. No market tracking required.
Strategy 1. Automatic recurring investments through a 401k or IRA. In midlife, when life is consumed by work, family, and financial responsibilities, investing often becomes something we postpone. While most people understand that investing is the surest path to building long-term wealth, a packed schedule and daily priorities can make it hard to find the time or the headspace to stay on top of the market. But the truth is, you don't need to be a financial expert or spend hours staring at a screen to invest effectively. One of the simplest, smartest, and most time-efficient strategies for busy people is to automate your investing through a 401k or IRA retirement account. 401ks and IRAs are two of the most common retirement accounts in the U.S., designed specifically to help working Americans build wealth for their future. Their most powerful feature? The ability to automatically deduct a portion of your paycheck and invest it on a monthly or quarterly basis. That means you don't have to remember to transfer money every month. You won't waste time wondering, is now a good time to invest? And you won't be stressed by short-term market swings. Everything is set up once and then runs on autopilot. This is the heart of passive investing, letting your money work for you while you focus on the things that matter most in life. Recurring investments like these also offer a powerful benefit called dollar-cost averaging, a strategy where you invest a fixed amount of money on a regular schedule, regardless of whether the market is up or down. Over time, this allows you to buy more shares when prices are low and fewer when prices are high, helping you average out your cost and reduce risk caused by market volatility. For anyone who doesn't have the time or energy to monitor financial news daily, this is an incredibly wise and accessible approach. Beyond convenience and consistency, investing through a 401k or IRA harnesses the power of compound interest, arguably the most important factor in long-term wealth building. If you invest just $500 per month for 20 years at an average annual return of 7%, you won't just have the $120,000 you contributed. Your total could nearly double thanks to interest earning interest. And the best part? You don't need to do anything. Just stay disciplined with your monthly contributions and let time and the market do the rest. There's more. 401ks and IRAs also offer significant tax advantages. With a traditional 401k or IRA, your contributions are made with pre-tax dollars, reducing your taxable income today. With a Roth IRA, your earnings grow tax-free and can be withdrawn without taxes in retirement. These are powerful tools that allow your money to grow more efficiently without hidden costs eating into your gains. If you're working for an employer that offers matching contributions, that's essentially free money. Every dollar your employer matches in your 401k is money you didn't have to earn, and no smart investor should leave that on the table. Especially for those in their 40s and beyond who are trying to catch up on retirement savings, this matching benefit can make a significant long-term difference. But perhaps the greatest strength of this strategy lies in its simplicity and low stress. Investing no longer has to be a mental burden. You don't need to analyze charts, read economic forecasts, or react to headlines. Once it's automated, your financial habit becomes a seamless part of your life, healthy, sustainable, and worry-free. More importantly, understand this: not investing is the biggest risk of all. Inflation is silently eroding the value of your cash every year, and if your money is sitting in a low-interest savings account, you're falling behind. Waiting for the perfect time to invest only causes you to miss out on the most valuable asset you have: time. Every year you delay is a year compound interest can't do its work. With all the benefits, from automation, consistency, and long-term growth to tax advantages and peace of mind, recurring investments through a 401k or IRA are hands down one of the best strategies for building wealth without sacrificing your time or mental energy. For busy midlife adults, this is an ideal path. Low stress, low maintenance, yet profoundly effective over the long run. If you're looking for a smart, sustainable way to secure your financial future while still having time to enjoy the present, now is the time to begin.
Strategy 2. Invest through index ETFs. When people think about investing, many imagine picking stocks, analyzing financial reports, or trying to predict market swings. For busy midlife adults, that sounds more like taking on a second job, and most simply don't have the time or the patience for it. But here's the truth. You don't need to become a market analyst to invest successfully. Index tracking ETFs, or exchange-traded funds, are the ideal investment vehicle for those who want steady, long-term returns without spending hours researching every move. An ETF, or exchange-traded fund, is an investment fund that trades like a stock on the stock market. But what makes index ETFs unique is that they don't focus on individual companies, they track an entire market index, such as the S&P 500, which represents 500 of America's top companies, including Apple, Microsoft, Coca-Cola, and Johnson & Johnson. Instead of guessing which company might take off next, you're betting on the long-term strength of the entire U.S. economy. The first major advantage of this approach is low cost. Index ETFs typically come with extremely low management fees, since they're designed to mirror an index and don't require a large team of analysts or frequent trading. Compared to traditional mutual funds or building your own stock portfolio, the cost savings over time, especially when combined with the power of compound returns, can be massive. Another big benefit? Built-in diversification. When you invest in an ETF that tracks the S&P 500, you're indirectly owning a slice of hundreds of major companies across multiple industries. If one sector takes a hit, others may help offset the losses. If a few companies underperform, dozens more can keep your portfolio balanced. It's the simplest way to create a smart, diversified investment portfolio and avoid the concentration risks that many inexperienced investors fall into. And the best part? You don't have to do anything else. No digging through earnings reports, no guessing market trends, no shuffling your portfolio every quarter. With index ETFs, you can set up recurring monthly investments and let your wealth grow alongside the broader market. Historically, the S&P 500 has delivered average annual returns of around 7 to 10% over the long term, despite short-term fluctuations. This means that if you consistently invest in an ETF tracking the S&P 500, your money can grow steadily without the stress of daily market monitoring. Even better, many ETFs now allow for automated investing, combined with a dollar-cost averaging strategy, where you invest a fixed amount at regular intervals. This is especially ideal for people in their 40s to 60s who want to prepare for retirement intelligently, without sacrificing precious time with their families or careers. And you don't need a fortune to get started. With as little as a few dozen to a few $100s per month, you can begin investing in a fund that tracks the entire market. It's an open door to powerful financial tools that were once reserved for the wealthy, now available to anyone at any income level. In short, if you're looking for an investment option that's simple, low cost, low risk, and doesn't require hours of research, index ETFs are a must-have strategy. You're investing in the long-term growth of the United States, the world's most stable and dynamic economy. And more importantly, you're building wealth without sacrificing the peace of mind that your busy life demands.
Strategy 3.
Use robo-advisors. In today's fast-paced, tech-driven world, automation has transformed nearly every aspect of our lives, and investing is no exception. If you're in your 40s or 50s with a stable income but little time to track the markets, analyze charts, or design complex investment plans, robo-advisors offer a smart, hands-off solution designed exactly for people like you. A robo-advisor is a digital investment platform that uses artificial intelligence to build and manage your portfolio automatically. Based on a few simple inputs, your age, goals, risk tolerance, and investment timeline, the platform creates a customized portfolio and manages it on your behalf. It's like having a personal financial advisor working for you 24/7 without the hefty fees that traditional advisors often charge. One of the greatest strengths of robo-advisors is automatic rebalancing. Over time, your portfolio may drift from its intended allocation as the market shifts. For example, stocks may grow faster than bonds. Instead of leaving you to rebalance it yourself, something most people forget or do incorrectly, robo-advisors monitor and adjust your portfolio regularly to keep it aligned with your original plan, optimizing performance while minimizing risk. Many platforms also offer tax loss harvesting, a strategy that automatically sells certain investments at a temporary loss to offset capital gains and reduce your tax bill. It's a sophisticated tactic that used to be available only to high net worth individuals with personal advisors, now made accessible and fully automated by technology. What makes robo-advisors especially appealing for busy professionals is their ease of use and time-saving design. You don't need to be a finance expert. You don't need to read reports, study charts, or watch CNBC every morning. Just download the app, answer a few questions, deposit your funds, and let the system handle the rest. You can check your progress from your phone, during lunch breaks, while waiting in line, or sitting in the carpool lane. It's simple, transparent, and entirely stress-free. And let's talk about cost. Traditional financial advisors often charge 1 to 2% of your total assets per year, which can add up to tens of thousands of dollars over time. By contrast, most robo-advisors like Betterment, Wealthfront, or SoFi Invest charge as little as 0.25 to 0.5%, and some even offer free plans for smaller portfolios. Over the long term, those savings make a huge difference, all while achieving comparable or even better results through efficient automation. In short, robo-advisors combine the power of technology with proven financial strategies to help you invest smartly without the stress, time, or complexity. With this model, you're investing like a professional portfolio manager without needing to become one yourself. For busy Americans in midlife looking for a passive, flexible, and time-efficient way to grow wealth, AI-powered investing is a game changer. You don't need to know every stock symbol or understand every market cycle. You just need a clear goal, and the system will take care of the rest. In a world where time is your most valuable asset, this is one of the smartest ways to let your money grow while you keep living life on your terms.
Strategy 4. Invest in U.S. government bonds or short-term bond funds. As we enter our 40s, 50s, or 60s, financial priorities begin to shift. After years of working, saving, and investing, the goal is no longer chasing the highest returns. It's protecting what you've built. You want your money to keep working, but without the stress of watching volatile markets. That's where U.S. Treasury bonds and short-term bond funds come in, offering stability, predictable income, and peace of mind. Treasury bonds are essentially loans you make to the U.S. government, which in return promises to pay you back with interest over a set period of time. Because they're backed by the full faith and credit of the United States, one of the most trusted financial entities in the world, they are considered one of the safest investments available. That's why many seasoned investors and large retirement funds allocate a portion of their portfolio to these bonds. For added flexibility, Short-term bond funds are another smart option. These funds invest in bonds with shorter maturities, typically under 3 years, making them less sensitive to interest rate changes and market volatility. They provide professional management, steady performance, and easy liquidity, so you can access your money when needed without much hassle. The biggest advantage of this strategy is stable cash flow. While they won't deliver the explosive growth of stocks or real estate, Treasury bonds and short-term bond funds generate reliable income through interest payments, a crucial feature for anyone approaching or already in retirement. These steady returns can help you cover daily expenses, reinvest strategically, or simply give you more control over your financial future. Even more importantly, bonds serve as a buffer in your portfolio during turbulent times. When stocks tumble or the economy slows down, having a healthy bond allocation can help preserve your capital and reduce losses. That kind of stability is essential when you're shifting from wealth accumulation to wealth preservation. Bonds allow you to stay calm and collected, so you're never forced to sell other investments at the wrong time just to cover your needs. Accessibility is another major benefit. You can buy U.S. Treasury bonds directly from the government at Treasury Direct or invest in bond funds through trusted platforms like Vanguard, Fidelity, or Charles Schwab. Many funds have low minimum investment requirements, making them ideal even for beginners who want to start building a safer, more diversified portfolio. In today's environment, where savings account interest rates are often disappointing and the market remains unpredictable, allocating a portion of your assets to government bonds or short-term bond funds is a smart, balanced approach. It's a way to preserve your wealth, earn passive income, and add a layer of security to your financial life. If you're in midlife and want an investment strategy that won't keep you up at night, Treasury bonds and short-term bond funds are an excellent choice. They won't just stabilize your finances, they'll give you the peace of mind you deserve as you prepare for the next chapter of life. In a time when uncertainty is everywhere, that kind of quiet confidence is priceless.
Strategy 5. Set it and forget it. In the world of investing, where market headlines shift by the hour and emotions swing with every fluctuation, there's one strategy that stands out for its simplicity and effectiveness, especially for busy, middle-aged individuals. Set it and forget it. This isn't an app, a fancy product, or a new technology. It's a long-term investment philosophy, one that financial experts like Warren Buffett have advocated for decades, and it works. At its core, the strategy is simple. You build a strong, diversified portfolio, typically using index funds or ETFs that spread out risk, set up an automated investment plan, and then leave it alone. You don't try to buy the dip, you don't panic every time the market drops, and you don't chase the latest investing trends. The first and most powerful benefit of this approach is that it removes emotion from your financial decisions, one of the biggest reasons people lose money. Instead of overreacting to short-term volatility, you stick to your plan. You avoid the costly mistakes of selling in fear when the market dips or buying in greed when prices surge. In other words, you don't get shaken by bad news or fleeting emotions. Set it and forget it also frees up your time and mental energy, something invaluable for anyone trying to balance work, family, and personal well-being. You're not glued to charts, you're not checking your investment account every day, and you're not buried in market updates. That's especially important for people in their 40s, 50s, or 60s, those who value stability and efficiency over chasing the next hot stock. One of the key reasons this strategy works so well is because of the power of compound interest. When you let your portfolio grow steadily over the long term, your returns don't just come from the money you put in, they also come from the returns that money earns over time. Your money starts working for you, and time becomes your greatest ally. Investors who stay the course and avoid pulling out early typically see far better results than those who try to beat the market. In fact, study after study has shown that investment portfolios left untouched for years often outperform those that are constantly bought and sold. Why?
because frequent trading doesn't just rack up extra fees and taxes, it increases your chances of making poor decisions based on emotion. Meanwhile, those who simply invest and leave it alone for 10 or 20 years often end up being rewarded with steady and significant growth. This strategy is also incredibly flexible. You can use it with a 401k, an IRA, or a personal investment account. Just pick a solid index fund, like an S&P 500 ETF, set up monthly contributions, even starting at just $100, and let the system take care of the rest. That's all you need to begin building long-term sustainable wealth. In short, if you're looking for an investment strategy that's simple, effective, and doesn't demand a lot of your time, set it and forget it may be your perfect match. You don't need to be a financial expert. You don't need to analyze complex charts. All you need is commitment, consistency, and the patience to let time do the heavy lifting. Building wealth shouldn't be stressful, even when you're busy. The 5 strategies we covered prove that a disciplined, long-term approach works wonders. The most important step is starting today. Effective investing is consistent, not complicated. If you're ready to grow your assets quietly while you live your life, hit like, subscribe, and share this video. We have more practical content coming your way. See you next time.